Hello, everyone. Welcome to this new session from Impact Taxation and Financial Services. Okay, so today's topic is 10 things you can do now to multiply retirement savings without financial planning. Okay, so let's have a look what you can do. And before we go to the main content of this session, we just want to declare that the information provided here is for general information only. So before making any decisions, please contact an experienced tax agent, financial planner, solicitor, or one of our power planners. And we're not financial planners and will not provide any financial product advice and any other advice that's only covered by a registered financial planner. Also, we're not solicitors and will not provide any legal advice. So wherever possible or necessary for all the planning strategies, we work closely with our legal associates to provide the ultimate solutions together. Okay, so let's have a look. So here is actually, we adapted this one from a real client, a real power planning client. So basically, it's the person, if he just carry on what he's doing now with no strategy at all, his net asset will last to when he's about 84 years old. So then if he adopt all the super related strategies, okay, his net asset will last to until he's at age 98. So quite a big increase, okay? So only with super strategies, we're going to mention a bit later in the session. And then with combined strategies, that means with both his super fund and his wealth outside super fund, he's adopting all the combined strategies, then he's going to never spend all his net assets. So by the time he passes away, because you can see the trend is still going up when he's at age 98. So when he passes away in the future, he's still going to have a huge asset base to pass down to his family members. Okay, so that's how power planning is going to make a big difference. Okay, so let's go through what are the 10 things you can do now to maximize your future retirement savings. Okay, so oh, actually, one thing I want to mention too. Okay, if you don't have any strategy, this person, he had about 5 million. Yeah, one at the moment when he need to retire. With super strategies, it's actually doubled up. Yeah, a bit more than 10 million. With combined strategies, yeah, there's no limit. It just keep going up. All right. All right, let's have a look at how you can do that potentially. Okay. First thing is you need to maximize concessional super contributions. Okay. So of course, the downside of it is the money will be locked in inside your super fund. So you need to make sure that you do have surplus cash and you don't need the money now and for future short-term financial goals. Okay. And the current annual cap is at $27,500 per year. So one thing very important you need to know, that total amount is including employer super guarantee contributions. So you need to include that in the total calculation. And you can also use carried forward unused super contributions. Okay, so starting from 2019, you can actually carry forward unused super contribution caps, and then actually you have a limit of years, that's 5 years. So that means in 2024 tax year, you can actually still utilize any unused super cap from 2019 tax year. Okay, and this is also applicable to high income earners with actual 15% tax. So it's called 293, division 293 tax. So for high income earners above 250K a year, they do pay another 15% on top of the normal 15% when they do concessional contributions. But the difference is even include that, okay, their marginal tax rate is going to be 30% in the super environment, but outside is going to be 47%. So they are still saving tax. All right. So let's have a look at the tax saving points for concessional super contribution, because I think it's a common misconception. People believe, okay, the only point of tax saving is when you are making the contribution. It's actually far from that. Okay. So of course, when you make the contribution, you are saving tax. So 15% inside super, instead of your marginal tax rate outside super, because you can claim an outright deduction outside super against your other income. And then that's point one on your tax saving. Point two is on your future investment savings. Okay, so all your future investment savings in super environment is also taxed at 15%. If you were to invest anything outside super and you're actually having a tax profit on it, you're paying your marginal tax rate. All right. So point three, when you're saving tax, is actually when you're selling the investments. So when you're selling investments inside super, if you have held the investment for more than 12 months, you do receive a discount. So that will make the effective tax rate at the end on the capital gains tax at 10% only in super, okay, instead of marginal tax rate on discounted capital gain. So outside super, you do have a 50% discount as well. So that means if your marginal tax rate is 47%, so your capital gains tax will be 23.5%. Okay, so selling investment asset in super fund is still give you a major tax saving when you compare the two tax rates. All right, and then strategy two, utilize non-concessional super contribution if you're eligible. So at the moment, non-concessional super contribution, the cap is 110K a year. So non-concessional super contribution means you need to make after-tax contributions. So you have paid tax already, and then there's no tax deduction for this type of contributions. The reason why it's still beneficial for you is because you can still save tax on future income. So remember the 3 points we mentioned. Point one, the saving will be only for concessional super contribution, but for point two and three, you can still have tax benefits or savings when you're making after-tax contributions or non-concessional super contributions. Okay, so that's a very important strategy, especially for high-income earners. Okay, all right. Strategy three: reinvest surplus cash. So this actually happens a lot to people. They just leave their money there in their bank account. But the issue is when you have idle cash in the bank, it will earn no or minimum investment income. Yeah, if you earn interest, that's actually minimum. And then, the best recommendation we normally give people is you can set an emergency fund. So what do you need the most in terms of cash to make you confident, okay, that you're covering everything. So for myself, it might be say 100K. You might have a different amount. So then when you have more cash, more than 100K or more than the limit you have set for yourself, you should diligently reinvest your money. Okay, so keep your cash active. Okay, so you can do this for both your cash outside and inside super funds. Okay, inside super fund, especially for self-managed super funds, you also need to revisit how much cash you have all the time. Okay, set an emergency level and then reinvest. Okay, also reinvesting tax savings is key to your wealth growth. So the third model I've shown you at the very beginning of this session, the reason why that person is going to have a huge asset base before he pass away is because tax saving. Okay, so we helped him to build the best structures and then to achieve the back savings. And then if he diligently reinvest all the tax savings to the future years, that's actually the key to the wealth growth. All right. Okay, so number 4, determine the right order on debt repayments. So here there is an issue, I think, even with financial planning strategies too, because normally they'll ask you to line up all your debts and pay the debts with highest cost first, and then move down to the lower ones. But I think the main issue is actually ignoring tax. Okay, so we actually split it in 2-step process. Okay, step 1, you need to understand the real cost after tax. Okay, for tax purposes, you need to differentiate good debt and bad debt. So what is a good debt? One is tax deductible, okay, such as a loan on investment. Okay, it's a bad debt for tax purposes. One is not tax deductible, such as loan on main residence or any other private loan, okay, for private expenses. And the real cost of the loan is your after-tax interest, okay? So you need to find out after-tax interest for all your existing debts, okay? And then step 2 is you line up all debts using after-tax interest cost and pay them down from the highest one. All right, so this is a very good strategy for people who still have credit card debts, still have car loans. Okay, at the same time you have loans on main residence or private loans, and then also investment loans. All right, you need to line them up. All right, number 5, you need to include tax considerations when making investment choices. Okay, so of course, before you make any investment, you need to be aware of the related risks and then what's your risk tolerance. Okay, if it's something like this, you can consult with a financial planner. Okay, and then you need to use after-tax cost as investment cost, such as loan interest. So after tax here is really important. So basically just by removing your marginal tax rate, okay, then you also need to use your after-tax income as investment income, such as share dividends, okay? So, and then you can also consider income splitting for ownership structures. So when you're focusing on after-tax income, so after-tax income could be very different for different splits. Okay, if you have a family trust and you split income in many different ways, and you have a big family group, and many people are not earning a lot of individual income, you can even reduce your tax to nil. Okay, so there's a major difference. Okay, so that's why I also mentioned here financial modeling on your after-tax cash flow a must for complicated cases. Okay, this need to happen before you purchase investments. Okay, of course, for rental properties depend on whether the property is giving you a tax profit or tax loss. Then you need to decide how much you want to allocate to the high income earner of the family group or low income earner of the family group. Okay, so this is very important. All right. And then number 6, maximize loan borrowings on investments. Okay, so wherever you can, you should maximize your loan borrowings from the bank. Of course, you also need to consider whether you do have a good investment that's going to give you a higher return than the interest rate. Okay, this one is actually applicable to number 5 as well. So if you have a good investment that's going to give you, you're confident it's going to give you a good investment return for future years. So let's say if the return is going to be 8%, but the interest in the bank after tax, let's say, is only going to give you like say 4%. And then that means it's actually a good investment. All right. Okay. So when you're trying to maximize your loan borrowings, consider whether there are other ways to increase your existing loan borrowing. Say, for an example, when you buy a new investment property, is there any chance you can borrow a part or on the top? So let's say you can borrow 80%. Okay, so but you still need to use maybe another 25 to 30% to pay the down payment, pay for stamp duty, legal cost initially. Then that extra 25%, you can potentially organize a split loan, yeah, even with your main residence, and then increase the loan borrowing from the bank to 105% or even 110% of the total purchase price of the property. All right, that's a common strategy for like really smart investors. Okay, they utilize the bank's money to make their own money. Okay, but of course, it can be very complicated. So you got to consult with a good tax agent, yeah, tax planner, and then also find a good broker to help you. Yeah, we work with the best brokers as well to help us with complicated loans. If the loan structure is not right, then it's not going to work. Okay, so this is something really important. Okay, you need to make sure the loan structure is correct. Yeah, especially with the split loan I mentioned. Okay, so example one, use equities on existing properties to borrow more, okay, more than 100% on purchase price on new investment properties. I already mentioned this one, explained the theory behind. Example two is interest-only loans. Okay, this a lot of people can't get their mind around it because when they have a loan, they feel that it's always the best to pay it off. Okay, but with the interest-only loan, especially with investment property, you can actually free up more of your money when you don't have to pay down the principal of the loan. You free up more of your money to invest on other investments. Yeah, if that investment is going to give you a better return than the loan interest rate, then it's a good investment. You're going to get more money from it. All right. All right, let's have a look at strategy number 7. So invest based on timing of your financial goals. So when you have a long-term investment, okay, or the other way around, you need to have a look at how much money you can allocate to long-term investment. So have a look at your short-term goals, long-term goals, and then invest your money accordingly. Okay, so if you have long-term goals that's only for retirement, then you need to focus on long-term investment. Of course, long-term investment, if you don't need the money now, what's the best structure for you to invest? Of course, in super funds. All right, so that's very important. We do have sometimes with our power planning clients, when they come to us, they're paying 47% on tax, okay, top marginal tax rate. But at the same time, they don't do any super contribution, okay? And then when we ask them, why are you investing? Yeah, paying for that 47% tax, their main purpose is for future retirement. Okay, so then why wouldn't you transfer more money as much as possible to super fund and invest there? Okay, that's important too. So line up the timing tax, okay, of all your investments with your timing, okay. All right, so and then if you have short-term investment goals, let's say you might want to save up enough money in 5 years to be able to purchase another rental property. Okay, for that type of investment, you want to invest on short-term investment, okay, term deposit, bonds, okay, and then when you have enough money, you can withdraw altogether and then pay the down payment for the next rental property, okay. Then it's going to make your cash flow very efficient. Okay, you keep using it to earn maximum, yeah, with the right term, okay, right timing. Okay, and then also at the same time, you need to understand cash flow and tax difference on similar investments, such as apartments and house with land. So when sometimes when people mention, okay, I want to invest on rental property market. Okay, so when you think about it, and a brand new, close to brand new apartment and house with land or with a very old property on a big piece of land, they are very different investments. Okay, so close to brand new apartments, they are normally more focused on the current tax savings. Okay, people can use them to claim a lot of depreciation, so they can cut down their tax payment on other income. Okay, that's normally a short-term purpose. Okay, for tax saving, and also for the investment return. So sometimes the apartment can provide a positive cash flow. So it can happen. It can provide a positive cash flow at the same time with a tax deduction or negative gearing. Okay, that's possible. And house with land, especially when it's a big piece of land with a very small house and very old, then you wouldn't be able to claim a lot of tax deduction or claim the a lot on the deduction. The major purpose is actually for the future for capital gain, because land will not give you any depreciation or deduction on depreciation, but it's going to increase in value more on capital gain in the future. All right. So they are very different investments. Okay. All right. Let's have a look at number 8. Choose the best ownership structure for investments. Okay. So all the strategies, they are actually hand in hand with each other. Okay. The best investment structures will help you to minimize taxes for your family group, like the examples we mentioned earlier. Okay. If you have a big family group and then many other people who doesn't earn a big income, yeah. So family trust might help you to reduce your tax by quite a lot on your future investments. Okay, especially if you set it up in the right way, and then also a good ownership structure will help you to protect your assets. Okay, it will also help with your strategies on succession planning and estate planning in the future. Okay, so for this, you can actually, we did provide some like a very thorough session earlier on how should you own your asset and investments. So you can actually watch that YouTube video to get more details. Okay, all right. So number, did I do it wrong in the numbers? But that's okay. Yeah, but let's keep going. So advanced tax planning each year for family group, I think that should be number 9, but anyway, okay. So you can actually utilize a 3-dimensional tax planning for each tax paying entity in the family group. So we actually have a separate YouTube video on this as well. So 3-dimensional tax planning means you actually focus on each separate entity in your family group and make sure you're maximizing deductions or utilize all strategies for that one entity separately. Then you, the second dimension, you line up all your family group or separate entities, and then drill in to see which entity is the best to receive income and which is the best to receive deduction. Of course, within tax law requirements. Okay, so that's the second dimension. Third dimension is look into the future. Okay, especially on your ownership structure, the income splitting strategies. Okay, what's the best ownership structure for the long-term tax saving? So that's the 3-dimensional tax planning strategies. Okay, and then basically you should adopt all available tax strategies to minimize your deductions for each entity and for the whole family group. Okay, then every year you should revisit income and expenses close to the end of the tax year. So because up to, let's say, May or June every year, you would have a good idea on how much income you're receiving for the current year. And then if your income is really high, you can potentially move some income to future year if it's possible. You know, you can postpone your bonus, for example, or you can move forward deductions, expenses. Okay, so there are key strategies you can utilize May, June every year. So for our big clients, we always give them a tax planning session every year, you know, May and June. That's really important. Okay, so then also, of course, very important, watch out timing on selling investments. Yeah, so that's also linked to your other income. So if you don't sell them in the right moment, especially closely to the end of the year. The tax payment could be very different. Yeah, we had a client before, I think it was in April. He came to us, he said, "Oh, I want to sell 3 properties by June." And then each of them will give him a huge capital gain. And then by postponing just 2 of them to July, August, he's saving tens of thousands of dollars on capital gain. So that's actually something important. So tax planning is really important from year to year. All right, and then next one, utilize advanced asset protection strategies. Again, this is important because asset protection is critical to protect your family wealth. Imagine if you have a huge wealth accumulated already, but something happened to that structure, you could risk losing everything. So whatever you have done, utilizing all the other strategies, that's all in vain. So asset protection is super important, especially for business owners or company directors. Yeah, because they are exposed to more risks than people who's only receiving employment income. All right, so this is really important. There are a lot of complicated structures related to asset protection. So for this, you actually need to organize a separate consultation with us. We also have other videos online. Yeah, you can actually have a look, especially on asset protection strategies for different business structures. All right. Okay, number 10, you need to adopt advanced succession planning strategies. Okay, so good succession planning means someone you trust will look after your asset when something happens to you. So I'll give you one example. We had a past client, but unfortunately, something happened to him. Okay, he had a traffic accident, and then because for the family trust, when he joined us, we did try to convince him to change the structure. And then because he was the only appointor for the family trust, so only director for the corporate trustee, all right, the only shareholder for the corporate trustee. So all the control of the family asset they're all under his name. So after he had a traffic accident, he was unconscious in the hospital for quite a long period of time. During that time, the family members can't get any money out or any asset out from the family trust structure. Yeah, because he's the only person who's having the sole control of the family asset within that structure. So this is the reason why a good succession planning strategy is super important. So if something happens to you, if you have the strategy set up beforehand, someone will take over right away, okay, to help out with the family, okay, to have access of the asset and money captured in the structure, okay. And then also it will provide a good foundation for future estate planning. Estate planning is a very complicated area. A lot of people believe if they have a will, their assets are protected and they will be passed down to the people they nominated in the will, but it's actually not the case, okay? Because there's a 6 months waiting period. If during that 6 months, someone challenged the will, yeah, if you have an ex-spouse, stepchildren from marriages before, they could come in and challenge the will, okay? So a good structure succession planning strategy is actually linked with estate planning as well to make sure that all your asset and wealth, they actually get passed down to your bloodline, after you pass away. So that's important too. All right, that's everything. That's all the strategies. So a very brief introduction about myself. I got 2 master degrees, one in Master of Commerce in accounting, and also Master of Financial Planning. Okay, and I'm a CPA, I'm a tax agent. Yeah, so that's me. Here's also my contact details. If you have any questions about this session, let me know. Send me a message, drop me an email, and then we can explore further together. All right. All right. Thank you very much for attending this session. Looking forward to talking to you in the future.